Mohnish Pabrai, a successful Indian-American businessman and investor, known for his value investing strategies and his ability to replicate the investment strategies of Warren Buffett. If you want to follow the path of successful investors, it can be beneficial to imitate their investment strategies. Pabrai, who has a net worth of more than $100 million, admitted that he has no original ideas and simply cloned the best practices of others. His father, a relentless entrepreneur, experienced numerous failures, often leaving the family without enough money for groceries. However, Pabrai's father never gave up, instilling in Mohnish the values of perseverance and determination that would later shape his career. Pabrai was born in India and came to the United States to study engineering in Clemson University in South Carolina. After graduating, he worked at Tellabs for several years before starting his own software consulting firm in 1991. Following his tenure there, he took a leap and established his own successful IT consulting company called Transtech Incorporated in 1991 with around $70,000 in credit card debt and $30,000 from his 401k account. He managed to bootstrap the company. By the time he sold it to Kurt Salmon Associates in 2000, the company had generated over $20 million in revenue, earning him $6 million. After the triumphant sale of Transtech, Pabrai set his sights on conquering the financial markets. He was particularly inspired by the highly acclaimed Warren Buffett and his value investing principles. In fact, Pabrai once paid over $650,000 for the chance to have a charity lunch with Warren Buffett. Eager to learn from his success, Pabrai immersed himself in Buffett's investment approach, laying the foundation for his own investment philosophy. As Pabrai delved deeper into Buffett's approach, he uncovered a couple of key principles that form the basis of Buffett's stock-picking strategy, principles Buffett had learned from Benjamin Graham. The first principle is intrinsic value. When considering buying stocks, it's important to purchase them at a price much lower than what you estimate their net worth to actually be. This creates a gap between the current price and the intrinsic value of the company, which is called the margin of safety, a term introduced by Graham. To put it simply, if the market price of a security is significantly below your estimation of its true value, that difference represents a margin of safety. By buying stocks with a margin of safety, investors can minimize the potential for losses and make investments with minimal risks of downside. The margin of safety can be tailored according to an investor's risk preferences, allowing them to make informed decisions about their investments. Understanding the margin of safety. Let's say a stock is currently priced at $200, but it could be valued at either $100 or $300 in the future. In this scenario, buying it at $200 would be an unnecessary risk. According to Buffett, it's wiser to purchase the stock below its true worth, let's say at $100. By doing so, potential losses can be significantly reduced compared to buying it at $200. The margin of safety serves as a safeguard, ensuring minimal losses. Buffett uses an example to explain this concept. When you build a bridge, you insist that it can carry 30,000 pounds, but you only drive 10,000 pounds trucks across it. This same principle applies to investing. Recognizing the price of shares. In the short term, the stock market behaves like a voting machine, but in the long term it functions like a weighing machine. If you observe the stock chart of any company over a short period, you'll notice many ups and downs, like hills and mountains or valleys and throws. Stock prices can be unpredictable in the short term, and they don't always follow a straight path. However, if you zoom out and examine the price patterns over a slightly longer period, you'll gain a better understanding of the company's stock. The chart will reflect the company's actual performance. Extreme patience. During the years 1970 to 1972, when investors were filled with excitement and stock prices soared to their highest levels, Buffett hardly made any purchases. He believed that it's not about constantly making moves, but rather about being correct in their decisions. When it comes to waiting, he was willing to wait indefinitely. Then in 1973, when the stock market experienced a crash, he seized the opportunity and obtained a majority stake in the Washington Post Company, which he held onto for a remarkable 40 years. Investment philosophy of Mohnish Pabrai. In a book that he wrote called Dhandho Investor, he explained that a combination of low risk, high uncertainty is unusual, since the two parameters move in the opposite directions. High risk means higher chances of loss, while uncertainty refers to a wide range of possible outcomes. When the market is confused between risk and uncertainty, he pointed out those moments as profit opportunities. Pabrai suggested that investors need to think like entrepreneurs who search for low-risk business opportunities with high return. According to Pabrai, investing in well-established businesses with a well-defined business model ensures long-term return. These businesses are less risky than startups, but they can earn a decent profit even with a slight change in their business strategy. He quoted, "Look for mundane products that everyone needs. Following this requirement alone eliminates 99% of possible investment alternatives." Pabrai famously quoted, "Heads I win, tails I don't lose much." The quote summarizes his philosophy as an investor. It means picking up less risky stocks, but on the upside, it also has a wide possibility of profit. In 1999, Pabrai launched Pabrai Investment Funds, an ingenious family of hedge funds inspired by Buffett's investment partnership. From a humble beginning with just $1 million, Pabrai has skyrocketed the fund to an astonishing $1 billion in assets under management. His investment style, centered on uncovering undervalued gems with robust fundamentals, has propelled Pabrai and his firm to incredible success. One of Pabrai Investment Fund's most remarkable triumphs is their purchase of Fiat Chrysler automobile stocks in 2012. Mohnish invested in the company only to sell those stocks years later and gain over a 60% return on his investment. In recent times, Mohnish has shifted his attention towards philanthropy and given back, rather than solely accumulating wealth. In 2007 he and his wife established the Dhandho Foundation. This foundation provides intensive coaching to exceptionally talented students from impoverished backgrounds, preparing them for the entrance exam of the prestigious Indian Institute of Technology. The ultimate objective is to uplift these students from poverty and provide them with more opportunities. Pabrai's journey has been remarkable, considering the hardships his family faced in the past when they couldn't even afford basic groceries. Now let's delve deep into two key concepts that you can learn from Mohnish Pabrai. Copying successful individuals allows one to leverage the knowledge, experience, and expertise that they have already gained. Pabrai recognized Warren Buffett, widely regarded as one of the greatest investors of all time, had achieved exceptional results through his investment strategies. By carefully studying Buffett's approach, Pabrai harnessed this expertise, saving himself the time and effort required to reinvent the wheel. This principle can be applied to any field, enabling individuals to learn from the best and incorporate their proven methods into their own pursuits. Copying successful models provides a solid foundation for growth and development. Pabrai's decision to adopt Buffett's investment principles laid the groundwork for his success as an investor. Similarly, individuals in any field can benefit from studying and replicating the practices of established experts. By doing so, they can acquire a solid foundation of knowledge, skills, and techniques that have already been proven to be effective. This foundation provides a springboard for innovation, allowing individuals to build upon existing successes and push the boundaries of their chosen field.